Today, we're taking a deep dive into Clatch Fund's second quarter 2025 performance. And this isn't just, another financial report. It's a really compelling case study in navigating extreme market volatility. Offers some pretty unique insights into strategic flexibility and crisis management, too.
Yeah, what's truly fascinating here, I think, is how an investment firm didn't just sort of survive intense market pressure, but actually strategically adapted.
Yeah.
We're going to explore how Clash handled what they call the April tariff tantrum. That was a significant, really sudden period of heightened market volatility, specifically driven by escalating global trade tensions. It was a real test of their mettle, you could
Yeah,
say.
exactly. A Q test. And to understand their response, maybe we should quickly set the scene on Clatch itself. They're a data-driven investment firm, right? Started back in June 2020, specializing in probability-based options trading, mainly in U.S. markets. They've built their reputation on these proprietary quantitative models that systematically spot and act on what they call mispriced derivatives.
Right. And to give you a quick picture of that, think of mispriced derivatives as like finding a really valuable item in a flea market where nobody else quite sees its true worth yet. Their models essentially sift through just vast amounts of data to find options contracts that, well, the market seems to be valuing incorrectly. That creates opportunities for them. This highly analytical approach, backed by, a pretty consistent track record, over 12% net annualized returns for clients, that's really crucial context. Because the second quarter of 2025 just threw a curveball, unlike almost any other they'd seen.
Okay, so when this April tariff tantrum hit, trade tensions shooting up, markets reacting, pretty chaotically, Clatch faced a critical choice. What specific decisive action did they actually take? What set them apart from, the typical market reaction?
Well, they made a bold move, a highly strategic one. They rolled several options positions forward. Picture this. Instead of being forced to close out positions, maybe at a loss during that peak panic, they essentially paid a small premium, a cost, to extend the expiration dates of these contracts. They shifted them out into the fourth quarter of 2025 and even into the first quarter of 2026.
That sounds like a calculated gamble, though. What were the immediate implications? Because extending those positions, that must have tied up capital, right?
Absolutely. Yeah, this wasn't just a minor tweak. It was a very deliberate trade-off. While the main goal was to preserve their core portfolio exposures to avoid locking in losses during the panic, it definitely reduced their available buying power immediately. And the strategic decision directly impacted their performance, not just for Q2, but actually for the next 2 quarters as well. It was a conscious choice. Sacrifice some immediate flexibility for that longer-term strategic positioning, basically betting on their model's long-term view.
Right, okay. And given that very intentional decision, limiting their immediate buying power, what did their Q2 2025 performance actually look like in the end?
So the finalized results for Q2 2025, they show the Clatch Fund delivered a 2.80% return. Now, okay, on its own, 2.80% might not sound, earth-shattering. But, and this is the key part, when you consider it was achieved after they had deliberately reduced their buying power and during that extremely volatile tariff tantrum that caused so many others to struggle, well, it translates to an impressive 11.2% annualized return. This outcome really speaks volumes about the robustness of their underlying risk management framework and their conviction in their long-term ideas.
Yeah, that's where the real insight lies for us, isn't it? It wasn't just about surviving the storm. It was about performing positively despite deliberately taking that short-term hit to buying power. It truly highlights how their robust risk management and that unique adaptability allowed them to navigate really adverse conditions while, sticking to their core investment philosophy.
Exactly. And if we connect this to the bigger picture, it just underscores the critical role of, well, data-driven decision-making and continuous improvement. Clatch Fund isn't just resting on its laurels here. They're continuing to invest heavily in efficiency, in technology. These advancements aren't just for show. They're the engine that enables such precise, sometimes counterintuitive strategic moves. And that builds even greater long-term resilience in what's, let's face it, an ever-evolving market landscape.
So what does this all mean for you? Clatch Fund's second quarter of 2025 serves as, I think, a powerful example. It shows how proactive, disciplined portfolio management, even when it involves deliberate short-term trade-offs, can lead to positive outcomes during periods of intense market stress. They preserved their core strategy, didn't panic, and really set themselves up for future success.